the book, Unit 5. We are talking about accounting fundamentals now. Now, when we are talking about accounting fundamentals, accounting revolves around 5 different terminologies. We have come across a few of those and we are going to discuss all 5 of them, again. We start with what you call as assets. Assets are the resources owned by a business. Then we have liabilities. Liabilities are the owings or loans taken by the business. Then after that, we jump onto the third terminology which is associated with accounting. It is expenses. We have talked about all different types of cost in the previous chapter, so I'm not going to talk too much about expenses. Expenses are the payments made by the business for buying goods and services. Then after that, we jump on to the fourth terminology. The fourth terminology is basically what you call as incomes or revenues. Incomes or revenues refer to all the money earned by the business during a particular period of time through sale of goods and services normally. Then the fifth terminology is basically what you call as capital, sometimes also called owner's equity or shareholder funds. When we are talking about capital, it is basically the investment made by the business, investment made by the owner in the business, that is called owner's equity or capital. When it comes to limited companies, we have a lot of people who are investing the money in the business. They are called shareholders. That is why capital is sometimes also called shareholder funds or shareholders equity when we are talking about limited companies. So these 5 terminologies are basically there, around which the whole accounting process always revolves. And after that, we are going to basically jump on to the variations of these different terminologies, these 5 terminologies. We start with the different variations of assets. Assets are usually subdivided into 2 parts. We have current assets and we have non-current assets. Assets which are easily convertible into cash, assets that are that have a life of less than 1 year and which are usually bought for resale. These assets are called current assets. The examples are cash in hand, cash at bank. We have inventory and trade receivables. All these are examples of current assets. Then we have non-current assets. Non-current assets are the assets having a life of more than 1 year. They are not easily convertible into cash. They are not usually bought for resale. And these are basically, non-recurring payments made by the business for acquisition of assets whose life goes beyond 1 year. After these 2 assets, we are going to study 2 more types of assets which are related to the tangibility of them, physical existence or physical presence. The assets which can be felt or touched are called tangible assets, and all these assets like furnitures and fixtures and motor vehicles and land and building, these are called tangible assets. And then we have intangible assets which cannot be touched or felt. These are trademarks and logos and goodwill and copyrights and patents. All these are examples of intangible assets. After that, we are going to talk about liabilities, different types of liabilities. We have current liabilities and we have non-current liabilities. Loans that are payable by the business within 1 year are basically called current liabilities. Obligations that are to be paid within 1 year are called current liabilities. And then we are talking about non-current liabilities. Non-current liabilities are the loans which are payable beyond a period of 1 year, which are payable after 1 year. These type of loans, these type of liabilities are called non-current liabilities. Then we are going to jump on to expenses. We have already talked about them, all these variable costs and fixed costs and direct expenses and indirect expenses. So let's not go into the definitions of them, since we have just done them in the previous chapter. And then we are going to talk about the incomes as well. I just told you the definition of income, that is the money earned by the business over a certain period of time, usually through sale of goods and services. Revenue is usually also divided into 2 parts. We have direct revenue and we have indirect revenue. Direct revenue is the regular income that is earned by the business through its regular operations, and indirect revenue is the revenue which is one-off revenue, which is infrequent revenue, which is just going to be earned by the business infrequently and not on regular basis. We move on, and after that we are going to basically talk about two different types of financial statements that are called final accounts, and which are prepared at the end of every year, which are mandatory for most of the businesses in order to calculate their profits. When we are talking about these two different types of financial statements, we are talking about income statement and statement of financial position. Income statement, as the name is telling us, it records all the incomes of the business, and it subtracts expenses from the incomes to calculate different types of profit. We are able to calculate gross profit, net profit, and retained profit through preparation of income statement. When we are trying to calculate gross profit, that's the first part of income statement called the trading section. In the trading section, we subtract cost of goods sold from sales to get gross profit, and then in order to calculate net profit, we subtract or take away expenses from the gross profit to get to net profit. And when we take away dividends and other appropriations from the net profit, we reach a point which is called retained profit or retained earnings of the business. Now this is the mechanical preparation of income statement. When we are trying to define gross profit, it is a trading profit which is calculated by subtracting cost of goods sold from sales. And what is net profit? It is a profit saved by the business, or money saved by the business after paying off all its expenses during a particular period of time. And retained profit is the undistributed or unappropriated profit carried forward to the next year. Now, when we are talking about retained profit, normally when we are making income statements of sole trader and partnership, we are not going to come across the retained profit, and we are only going to be calculating gross profit and net profit only. And when we are making limited company income statement, then we are going to basically calculate retained profit as well. After this income statement, we are going to talk about the statement of financial position, which is sometimes also called balance sheet. The statement of financial position, it depicts the financial condition of the business by listing down all the assets, all the liabilities, and owner's equity. Basically, it proves the accounting equation, which is assets minus liabilities is equal to capital. All the assets, that is the non-current assets and current assets, are listed down at the beginning of the balance sheet or statement of financial position. Then we write down the current liabilities and then the non-current liabilities in order to find out shareholders' equity or shareholder funds in case of limited companies. So we are talking about all the assets, that is non-current assets and current assets, and then current liabilities, and then non-current liabilities. The non-current assets are written down first of all, then we take away current liabilities from current assets to find out working capital. The working capital is added to non-current assets to find out net assets or capital employed, and from capital employed or net assets we take away non-current liabilities to calculate shareholder funds. This is the first or top part of statement of financial position or balance sheet. The second part of statement of financial position or balance sheet is the financed by portion. In that we are going to have all the shareholder funds, that is in case of limited companies we are going to be talking about the share capital, and all the capital and revenue reserves are added to the share capital in order to find out shareholder funds. The top part and the bottom part, the totals of the top part and bottom part are always going to be equal if the balance sheet or statement of financial position has been made correctly. Okay, now when we are talking about these two financial statements, they have to have some kind of advantages for the business, otherwise what's the point of making these? So the income statement calculates three different types of profit. It lists down different types of expenses, that is all the direct and indirect expenses are written down along with appropriations as well. It is obviously when the expenses are identified, they can be managed more properly. We can do budgeting more appropriately using these values. We can have efficient allocation of resources. We can avoid the opportunity cost of holding extra profits or extra revenues. So a lot of advantages of making income statement. Obviously, we are depicting the performance of the business by comparing the current profits with the previous profits and with the competitors and with the industry averages as well. So, a lot of advantages of income statements. And then the disadvantages of income, the disadvantages, obviously it's tedious, it's time taking, it's not easy to understand for everyone. For non-accounting personnel, it may be hard to understand, and people are not going to be able to understand it properly very easily without any accounting background. And after that, we are going to jump on to the advantages of statement of financial position or balance sheet. It lists down or identifies all the assets and all the liabilities and the capital of the business. It depicts the liquidity of the business as well. That is the ability to pay off short-term debts through the calculation of working capital. It also helps in calculation of return on capital employed, and it also helps, that is the profitability can be calculated or depicted through this calculation. And then we have other things, other calculations that are being made. The capital employed or the total money available is also calculated through this balance sheet or statement of financial position. And we are talking about financial efficiency, which can also be gauged or measured through statement of financial position. After this, we finish this chapter through ratio analysis. Ratio analysis, we are just going to study 4 basic ratios which come under the scope of AS syllabus. Ratio analysis is the process of analyzing the performance of the business in terms of liquidity and profitability and financial efficiency and shareholder ratios and all the other gearing ratios and coverage ratios. But only 2 types of ratios come under the scope of AS, that is liquidity ratios and profitability ratios. Liquidity ratios obviously depict the ability of a business to pay off its short-term debts, and profitability ratios are going to tell us about the performance of the business. Now, when we are talking about liquidity ratios, we have to calculate 2 liquidity ratios in AS syllabus. The first one is current ratio, which is also sometimes called working capital ratios. Working capital ratio, the formula is current asset over current liabilities. The standard value has to fall between 1.5 and 2. If it is more than 1, if it is more than 2, then we are talking about having opportunity cost of holding extra current assets. If it is below 1.5, we are going to have working capital management problems and liquidity problems. On the other hand, and it depicts the liquidity for the next 12 months or 1 year. The second ratio, when we are talking about it, that is liquidity ratio, it is called quick ratio or acid test ratio, or sometimes liquid ratio. It depicts the liquidity of a business for the next 6 months. The formula is current assets minus closing inventory over current liabilities. So if the